Current liabilities. This is a review of the categories of liabilities: sales tax payable, unearned revenues, short-term notes payable, payroll liabilities, warranty liabilities, and contingent liabilities. Characteristics of a liability. A liability will exist as a result of a transaction or event, which represents a present obligation that came into being as a result of the past transaction or event, and it will require a future payment of cash and sometimes services. Especially when we're talking about unearned revenues, we'll have to sometimes provide services in relationship to the cash that we received. Current liabilities are due within 1 year or the company's operating cycle, whichever is longer. Most companies' operating cycles are much shorter than a year, so typically current liabilities are seen to be due, are those liabilities which are due within 1 year. These liabilities can be known, so in other words, we can know exactly who we have to pay and when we have to pay it. We can be estimated. We know that we will owe something, but we have to estimate how much we will owe, or they will be contingent upon future events. So let's look at some known liabilities. 1, sales tax payable. Retail companies collect sales tax from customers and transactions on behalf of the taxing authority, and then they remit to the taxing authority at the end of the month the amount of the sales tax that they've collected. So let's look at when a sale is made. So we have a sale of $5,000 here, but the customer is going to be paying $5,300 because in addition to the sales, they have to pay the sales tax payable, which the retail company is collecting on behalf of the sales tax authority. And because it's retail, we're also going to have to record the cost of goods sold or inventory that has left the store as a result of this transaction. Now, when the sales tax will be remitted to the taxing authority, typically at the end of the month, they're going to pay out the $300 in cash to the taxing authority, and they will no longer have a sales tax payable. Now, this probably will be much larger what they'll be paying out to the sales tax authority, more than the $300, but I kept the numbers consistent so you could see an example of the entire cycle of when they pay the taxing authority. Next, let's look at another known liability, unearned revenue. Well, we looked at this earlier when we talked about adjusting journal entries. So when a client pays cash in advance to a company for future products or services, such as when they pay NFL teams as ticket holders, they pay for a concert ahead of time, or they pay legal retainers to a law firm in anticipation of either a trial or as a company just having a lawyer on hand in case they run across a legal issue. They'll have somebody on retainer. So in this instance, I'm going to have an example here of somebody that's going to be paying cash to an attorney in anticipation of a trial. So they pay $60,000 to the attorney. The law firm records unearned legal retainers in the amount of $60,000. Now, once the trial has begun and some of the services have been rendered, the law firm is going to debit unearned legal retainers to show that they've earned a portion of the money that was previously given to them in the amount of $4,500. So now their legal fees are $4,500, and they owe this client less than they did originally because they've rendered some of the services. Now let's look at short-term notes payable. This is the same as notes receivable, but this represents the entity that owes the money. So we have the face value of a note. I don't know why I can't talk today. The face value of the note, $2,000. Here's the annual interest rate of 12%. So this will be the annual interest. So we're going to divide that by the banker's year in days of 360, and we're going to come up with a daily interest rate of 67 cents. The days outstanding on the note are going to be 60 days, which represent 2 months times 30 days per month, and the total interest due on the note will be $40. So when they pay off the note, they will be paying off the face value of the note, and in addition, they will be paying the total interest on the note in the amount of $2,040. So when they originally borrowed the money, this is the cash they received, and this shows the liability notes payable. When they pay off the note, they're going to be debiting interest expense, debiting the notes payable because they no longer owe the money, and then crediting cash for the entire amount that they're paying off. Now, what happens when you have a short-term notes payable when the due date of the note straddles the financial statement date? So you're going to have to separate out the interest associated with 1 year from the interest associated with another year. So let's look at this again. We have the same set of facts, same $40 that is owed. But the days that this is outstanding in 2014 represent 15 days, and in 2015 it represents 45 days. So we have the same face value of the note, the same 12%, the same annual interest rate, and we're going to divide the same annual interest rate by the banker's days in the banker's year in days and come up with the 67 cents per day. This will be the 15 days in 2014, so this will be the interest expense in 2014. These will be the 45 days in 2015 and the interest expense associated with 2015 of $30. Again, the cash payout and when the note becomes due in 2015 will be $2,040. But let's look at the difference in the transactions. So this is the $2,000 that was received in the recording of the liability, the notes payable. Now this is 2014 where we're going to recognize the interest expense associated with 2014 and also the interest that will be payable in 2015 that was incurred in 2014. Now, when we go to pay the note in 2015, we'll have to recognize the fact that we've paid off this interest payable. We've paid off the notes payable. We'll recognize the interest associated with 2015 of $30, and the cash that we'll pay out is the entire $2,040. Now, let's look at another known liability, payroll. Employer's expense. Now, this will be an expense to the employer, total gross payroll, but employees receive net pay, which is net of withholdings. What types of withholdings are taken from a paycheck? Well, they will include income tax payable, could also be state tax payable as well as federal tax payable, FICA taxes, which are Social Security and Medicare taxes, and any voluntary employee deductions for health insurance, etc. Laws will determine the amount of income taxes and FICA taxes that an employer will be taking out of the employee's paycheck. So here we have salary and wages expense of $45,000. Here we have the FICA associated with this payroll, the FICA Medicare associated with this payroll, the employee income tax payable, the employee medical insurance payable of $1,500. So this would be a voluntary insurance payable. Little misspelling there. And then this would be salaries payable or cash. So this would represent the net pay to the employees. Let's also talk about employer payroll taxes. In addition to having gross payroll as an expense, employers will pay and expense payroll taxes which are over and above the gross pay to employees. They must pay employer FICA and Social Security taxes as well as federal unemployment taxes and state unemployment taxes. So this will be payroll tax expense. Now notice that this is in addition to the $45,000 on the prior slide of payroll, salary and wages payroll expense. So this is payroll taxes expense, which is separate from the prior slide. So this was wages and salaries expense. This is payroll tax expense. So it's a separate calculation. So this will represent the employer's portion of Social Security taxes, the employer's portion of Medicare taxes, state unemployment taxes, and federal unemployment taxes. So estimated liabilities. Now let's switch categories from known liabilities to estimated liabilities. These arise from a past transaction and represent future payments, but the amount must be estimated based upon experience. The estimated amount is often challenged throughout the year to make certain that they have the correct amount estimated, and then they're calibrated. They can go up or down based upon the results. Estimated liabilities encompass things such as pension benefits, vacation pay, and bonus plans for employees. Now let's look at a special calculation that is often needed when you calculate a bonus plan. So in this instance, the bonus is equal to 6% of net income, and net income is $200,000. It will be calculated as 6% of net income minus the bonus, or bonus is equal to 6% of net income minus the bonus. Bonus is equal to 6% applied to the $200,000, which is $12,000, minus 6% of B, or bonus. Then we're going to algebraically solve this, and it'll be 0.06 bonus is equal to $12,000. Therefore, the bonus is equal to $12,000 divided by 0.06. The bonus is equal to $11,321. That's how you can do it algebraically, but in a common sense sort of way of solving it, you can take 6% of net income. 6% of $200,000 is $12,000, and then just simply divide it by 1 plus the bonus rate. So now let's look at another estimated liability, a particular issue having to do with warranties. Warranties are estimated and expensed in the year of the sale. So they are estimated and expensed in the year of the sale. The warranty is part of the expense of the sale because it helps to induce a customer to purchase the product. A lot of times, especially with washing machines and things that have a lot of moving parts, or cars and things of that nature, customers won't purchase this unless a warranty is also associated with the product. Therefore, this expense must be matched to the resulting sale. So in this instance, and there will be a certain percentage that management is using to estimate, based upon their experience, how many warranty expenses they will incur as a result of the sale. So in this year, they're recording warranty expense, warranty liability. Now, and subsequently, or in another year, when the customer brings in a product for service pursuant to the warranty liability will be reduced, but the expense only happens in the year of the sale, but the expense is not affected. So in this instance, we will be reducing the warranty liability by debiting it, and we will also record the fact that we are using repair parts in order to honor the warranty. Now let's look at contingent liabilities. This is all that you need to know on contingent liabilities, and it will be a good idea if you just memorize this. But let's walk through the thoughts behind it. These are possible liabilities arising from a past transaction that may not result in a future obligation. So let's look at this. If the future event is probable and estimable, you would record the liability. So let's say we had the BP oil spill. And it was really close to the financial statement date. It was probable that BP is going to owe something, but at that time it may not have been estimatable, so they're not going to record the liability then. So what would they do? It's probable but cannot be estimated. It will have to be disclosed in the financial statement notes. So they'll say, we know we owe something, but it's so close to the incident itself that we cannot really give you an estimate as to what it is, but we will owe something. Now let's look at another scenario where it's possible, but it cannot be estimated. So it's not nearly as likely as a probable event, but it's possible, and it still cannot be estimated. So since there's a more likelihood than if it were remote that something could be due as a result of that, it's going to be disclosed in the financial statement notes, and then all of the scenarios surrounding why it's possible will be disclosed and explained. Now, if we have something remote, just completely remote, disclosure is not required.